All right, recording is on. Today is Wednesday, August 14th. This is week 6, semester quickly coming to a close. So before we jump in, any questions, comments about anything?
Not yet.
Not yet?
I have a quick question, Professor, regarding the group project.
Yes.
So when you say for ROIC, you must discuss both levels.
Mm-hmm.
Do you mean the level at the operations margin and the other one, or you say with or without goodwill?
So when we did the analysis, we said the first level analysis for the ROIC was the tax rate, margin, productivity. And then the
Okay,
second level analysis is when you drill down on margin, you talk about gross margin, SG&A, and depreciation. And the second level analysis for productivity is working capital, PP&E, and goodwill.
got it.
So that's what we mean by the 2 levels of analysis.
Right. Thank you.
Sure. Nathan?
This is an administrative thing, but on Canvas, can you unhide the grades tab? When the assignments are graded, we have to like go to the assignment to see the grade versus the normal grades tab.
I didn't realize it was actually hidden. So hold on, let me just check. Sorry about that. Wish somebody had pointed that out to me before.
All good.
But let me go ahead and click disabled. Trying to figure out why it's disabled. That's really weird. All right, hopefully it should now be available on the menu. Oh, I gotta hit save. Sorry. All right, now it should be available. Sorry about that. Okay, anything else?
Yeah, Professor, I had a few questions about the group project too.
Right.
So for the multiples analysis, are we just supposed to email you with the companies that we pick and you'll send us the Bloomberg screenshots?
Actually, we're gonna cover that in class tonight.
Okay.
So, so let's talk about basically what we're gonna try and cover is we're gonna go over week 6 homework. We'll talk about the kind of midterm solution to the questions, and then we're gonna get into the group project assignments and the data, because you're gonna have to tell me which 2 peers tonight you want the data for that you're gonna be doing against. And then later this evening, I will get the data from Bloomberg and put the screenshots up so that you have all 3 companies' data to do that analysis with. So that'll
Okay.
be fine. So we'll come back to that. So why don't we start with the multiples assignment for this week? And I put, let's share my screen. In the files folder, a folder called week 5 down here. And it has two files, but includes the solution for this week mathematically that I put together. Okay. So let me start with that file. Back to Excel. Share that file. All right. Smaller. Starting out with the PEs. All right, so for Procter & Gamble, Estee Lauder, and Reckitt, basically, the cost of equities came from our WACC screenshot. The expected net income came from our EEO screenshot. For the expected return on equities, what I did is just kind of looked at the next 4 years on the EEO. And came up with about 34% for P&G, about 33% EL, and 27 RKT, and then basically match the PEs. And in fact, what I'm going to do is, instead of just sharing my screen, I'm going to go ahead and share my desktop, just so that I can pull this up. So for start out with P&G. Looking at return on equity, last year was 31, next 4 years, 32, 33, 33, 35. I chose 34. What's important about these two numbers when you're doing multiples is, remember, this is a perpetuity, okay? And when you do perpetuity growth rates, this isn't a 1-year growth rate. This isn't even a 5-year growth rate. This is a forever growth rate, compounded. All right, so think a 30-year growth rate. Same thing. That ROE is not the ROE at the end of 4 years. That is the very long-term return that the company is expecting. Okay, so essentially, that's what we're trying to get there. So it's not usually just just average the previous years. You're trying to understand what is the long-term incremental value for growth and return, because that's really what the key value drivers is all about, whether you're doing a PE or an enterprise value multiple. But those are the numbers that we're trying to represent. Okay, so same thing for Estee Lauder. So looking at Estee Lauder, based on what the analysts are saying, the important thing here is that, and you'll see that when we get to the ROIC, that Estee Lauder did not have a great year from an ROIC perspective, but ultimately, from return on equity perspective, it's expected to get a lot better over the next 4 years. And so the question is, was last year really a dip, and this year a dip, and the long term is more representative of the better, or are they more in a cyclical business where you're saying that it is going to be somewhere kind of between the two? I assume that it was really just coming out of COVID. They weren't doing as well, and long term they are expected to do better. So I'm giving them credit for the improvement and using the out years 3 and 4 is more representative of the future in my solution. That's where I got to 33%. And then for Reckitt, their return on equity again was 18, seemed to be improving to the mid to high 20s. And so again, I gave them credit for 27 on an improved long-term basis. All right, numbers could be slightly different than those, but again, just wanted to explain where the numbers of my solution came from.
Right.
In terms of ROE, go ahead.
So the second row, right, which is the net income, 1456
Yes.
for Estee Lauder.
Yeah, that should have come from second year net income, 1456. Right there.
But okay, shoots.
So we're using the second forward year in this class.
I think I made a clerical error, right? I thought the current year is 2024, so I just went to 2026.
Okay. Yeah, so again, the good news is it's not gonna really affect your multiples too much. Because going back here, even if I made this $1, it doesn't change the multiple, change the value, but it won't change the multiple. Okay, because again, key value driver is not affected by sizing. Remember, we talked about key value drivers.
Right.
But nonetheless, yeah, just we're using basically the second forward year, which is the first kind of clean 12-month forecast year. Now, if you'd used a third year, that's not the worst thing in the world, because sometimes the second forward year can be a little squirrely. And if the second forward year doesn't give you clean data, we do use a third forward year. So it's not an unreasonable assumption to have made. But for the
Right.
solution, we probably should have used the second forward year in this assignment.
Yeah, but you know what happened, Professor? I had to go to the actual multiple, like the PE. So if I choose fiscal year 25, then I choose the PE for 2025, which was very less than what it was in 2026. So
Well, the key there too is then if you do that, then you got to be consistent if you're comparing all the companies and using it in the same column.
right,
Because you don't want to, if you're doing a comparison for benchmarking, I don't want to compare a 25 multiple against a 24 multiple across companies, because now I'm looking at a little bit of an apple and an orange.
Right.
So that would have been the important part. So it's not saying, like I said, if you had done the third year multiple, you just had to consistently use that third year multiple for all three companies. That would have been the important thing. Somebody else had a hand up a second ago?
Yeah, you answered it with consistency and what years you use, especially if they're not aligned perfectly.
Yeah.
2 years
Well-
out was different for each company.
And again, sometimes, like we had this happen in the other class, where they were getting their data for group projects, and one of their companies was Peloton. And the problem is Peloton's not making money. So they actually changed their group project because it was getting difficult to value them, because if you have a loss, you don't have a multiple. So they couldn't use the second forward year because they don't have earnings to actually have a PE. So that's, or expected earnings. So that becomes a real challenge when you're doing a multiple analysis. And so it's essentially, you have to figure out when they're going to make money and do a multiple based on those potential future years. But then that kind of gets squirrely with who your peers are and you're comparing against too. So that's why, back to when we introduce multiples, and this is one thing McKinsey talks in the book as well, is that finding comparable companies is not as easy, and you probably start to see this as you think it is, because you need companies at similar stages of the life cycle. So for example, if Peloton is losing money for the next few years, then you don't want to compare them with a big stable gym that's very, very profitable, because it's almost like an apple and an orange. And finding somebody at a different stage means they're a little bit less comparable. I'm saying this is what we do. Sometimes we have to put square pegs in round holes, but that actually illustrates the challenge of multiples. But back to this data, anybody get something dramatically different for their ROEs? And then basically use the solvers to get the G. So those would have been the growth rates. And the headline here is that the major difference here, which is why, before we even get to the analysis, why Reckitt has such a low multiple compared to the other two, is you start to notice that they got a real low G compared to the other two. 1% versus 4 and 6. Yeah, Craig?
I was just to say, I used the ROE for Estee Lauder of 29% and 33 for Procter and Gamble.
Sorry, what did you use for Estee Lauder?
Estee Lauder, I did an ROE of 29%.
0.9?
29.
Oh, 29, sorry. Yeah, that's what I said. This is a little bit, and again, I'm going to editorialize for a second. Part of what I'm trying to illustrate here, and this isn't just valuation, this is how you approach financial modeling in the real world, particularly when you get to the future. There's the math side, which everybody here can do, right? It's the algebra of the math and the formulas and the equations. You got to learn that. But the real part is what assumptions do you use and why do you use them? Part of the reason why I ask you to do papers is that even in the real world, as I said, what people are going to be understanding is like, why did you use the numbers that you used as opposed to just plugging and chugging and solving an equation? And there is some uncertainty about the future. And that's why I said we're talking about perpetuity. And you could make an argument for 33. You can probably make a reasonable argument for 29. But that would be the point. Like, why are you using what you're using starts to become important. But I don't think that that's unreasonable in terms of the range. Matter of fact, you could argue that, hey, Estee Lauder is going to look more like it did last year in the future, and they're not going to see the improvement long term. And there's an EIC analysis for that. I can't say you're completely wrong because we are dealing with the future. That's why we do bulls and bears for valuations. But nonetheless, this is almost like an as is. So we are trying to get as representative as possible because we're dealing with a real share price. But as I said, 33.29, I don't think that that's going to be a big deal. The only difference is if you use a 29% ROE, then you're going to have a slightly higher growth rate than 6% because that's the trade-off. The higher your spread, the lower your growth. The higher the growth, the lower the spread. And that's because, again, there's potentially different ways to get to the same answer, but that's the point. My guess is your G is going to probably be like 6.3, 6.4.
6.21.
Okay, 6.2. Yeah, a little bit higher. Anybody have numbers dramatically different than this?
Yeah, my cost of equity is wrong, but I figured out I use the WACC, not the.
Yeah, a lot of data.
Yep.
A lot of data transpose.
Yeah, I mean, mine is different too because of the in the lower ROE I've assumed, Professor. So mine was like 4.76 for Estee Lauder, the G.
Okay, but what did you use for your ROE
31%.
and your cost of equity?
Cost 9.6%.
And you got to a G of 4?
Yes, 4.76.
Well, what PE did you use? Did you use the 23?
17.49 because of this year I got messed up.
Okay, because that would be why. Yeah, so to get to the lower PE, you clearly had to have a lower G.
Yeah.
But that just gets back to the consistency in the data issue. That was just a consistency issue.
Right.
All right. So the next piece is, before we analyze the premiums and discounts, I just want to talk about the EV to EBIT data. And this turned out to be a little bit more tricky than probably many of you had hoped. And particularly Estee Lauder's PE, but let me kind of talk about the operating ROIC. So again, same concept here. This, actually, all these numbers are perpetuity numbers. Same concept. So it's not what do I make in any one year, it's what is representative incrementally of the long term. So what's the incremental long-term growth rate? Same as PE. What's a similar ROIC for the long term? What's a similar tax rate for the long term? Right now, tax rates got off the guidance, so that was pretty straightforward. Although you could make an argument that 35 seems a little high. Meaning if everyone else is paying the 20s and they're in the industry, maybe that is a high watermark, and in perpetuity, they should pay a little bit more, particularly because the corporate tax rate in the US is not 35% anymore. Even in a worst case scenario, it's going to go to 28 if the tax cuts get raised in a future Democratic administration. So that you could make an argument that 35 is not the right number and could put it lower, but I just use the guidance number as the long term as a starting point. The tricky part would have been here in the ROIC. Okay? And essentially, I want to kind of just remind everybody that when you're trying to do a long-term number, whether it's ROIC or ROE, right? There's kind of 4 ways you can get there. Right? The ideal way is you do an as-is valuation, right? Because when you do a DCF, right, you're kind of modeling out a long-term ROIC by definition, okay? The perpetuity ROIC, okay? That's what's going to be in your assumptions page. And that should be the same ROIC long-term that we use here in the multiples, okay? one company shouldn't have a different ROIC for two different approaches. So that would be the best. Now, I didn't give you the data to do the modeled out ROIC for these companies. So then method number two is basically what I started to hint at last week and also in the announcement, which is there should be a correlation between ROIC and ROE. Okay, just conceptually, they're basically relatable by the leverage ratio. And so essentially you shouldn't have a gigantic discrepancy between the ROIC and the ROE that's not explainable by leverage. Okay, so in the case of Estee Lauder, the third method that we hinted at was historical data. Problem is, when we look at the historical spread of Estee Lauder, which sheet is right here, 5% ROIC, clearly, plug a 5% ROIC, the past is probably not indicative of the future, okay? And if you put in a 5% ROIC, then you're gonna have really weird growth rates. And then you're gonna have a hard time explaining the growth rates that actually make this model work. Because you're gonna have to have a negative G with a negative spread to get a high multiple. And we start getting the negative Gs, that becomes harder to explain. So especially for a company that's, if you look at their EEO, is not losing money and clearly improving their performance over time. So those numbers start to get really disconnected. So, but I'm saying this is kind of method number three. And you could say, well, you know, the past is representative of the future, but the problem is for Estee Lauder, it's really not. Especially when you start to compare that to the EEO, but you can still look at that. That is a method that you can do. And by the way, method number four is the comparable method, which is Estee Lauder is not doing so well now. What would they look like when they're better? Oh, they're kind of like L'Oreal. So what I'm going to say is Estee Lauder will eventually earn a L'Oreal's rate of return. Okay. Now, again, that's less than ideal. That's why I'll put in that fourth bucket. But you could have also done something like that for Estee Lauder. You could have used something to say, you know, hey, they're going to improve. What is a level of improvement? Well, they're kind of like this other company, so they'll probably earn about that rate over time, plus or minus a little bit. You could have made that argument in this analysis. I don't know if anybody did, but that could have been an acceptable way, although it probably would put a pretty low ranking in terms of, is that the best way to do it? Okay, so I'll come back to that, but see some hands popping up. So start with Stephen.
So quick question. So if you have the as is, which is obviously the most ideal, but you don't necessarily have that for the two other companies you're comparing, I'm guessing you have to remain consistent in which method you do choose, or can you pick like, okay, we have Estee Lauder's as is, so we can go with that, and then we go with the less ideal options because that's what's available for us.
Yeah.
Okay, that's good to know.
What I would say is, generally you want to be consistent in your methodology, but if in terms of trying to figure out the ROIC, if I have an as is, I still want to use that ideally, and then for the other two, if I don't have that, use the best method I think approximates it, because the goal is to try and be an approximation of the long term. The nuance is, if I'm using, for example, year 2 data, I don't want to use year 2 data for one company, year 3 data for another company. That's the inconsistency you got to be kind of more careful about. But the goal is we want to be as accurate as possible, which is hard to say paradoxically when we're talking about the future, but for these as is valuations. And so if I can use what I'll call method 1, which is an as is DCF, I always want to go with that, because I think that's going to be a good representation of what the market's probably looking at for the company. Then if I don't have that for the other companies, use something else that I think gets me close, but I wouldn't compromise my using the first one for P and G if that happened to be where we had our DCF. Now this one, we didn't have a DCF for any of them. So, you know, here we could be a little consistent. All right, Skylar.
So for this exercise, if we had used the ROIC from the spread screen, so like I used 17.8 for Procter and 8.1 for RKT, and then for Estee Lauder I used a slightly higher one, would that just be considered like wrong, or is it still like open for interpretation?
The honest answer is, it depends on what you said in your write-up.
Okay, so
Meaning-
we had to defend which
You gotta defend what
ROIC
you
number
do.
we used.
So what you would have had to say, let's say you used an ROIC for Estee Lauder under 8 long term. What you're gonna have to defend is why you have a negative spread long term for them, and why you're essentially gonna have to have a negative growth rate to get to that higher multiple, because that's the only way you're gonna get to a reasonable multiple, is to get a really negative growth rate with a negative spread. And you have to explain that logically.
Right,
And
so-
what I mean by that is, if Estee Lauder has, and this goes back to why would you have a negative growth rate? You know, take the company's revenue and profits, you got negative 2% growth rate, then just take their current revenue and profits and multiply by 0.98, 0.98, 0.98 for every year going out. Can you explain that? You might be able to. That's Merck. You know, patent expired, best of times, next 5 years, probably long term, hard to replace that drug. I can understand that. You start showing me a negative growth rate of like negative 15%, take Estee Lauder's revenue, knock it down by 85% every year. Well, that kind of defies what you're seeing in the real world with them, even in the EEO. And so that growth rate in perpetuity starts to get a lot harder to defend and make sense. So that it kind of clues you in, and that's why I make you guys do these write-ups, because like I said, I know you can come up with a mathematical solution for the numbers that you put in there, but does the assumptions that I put in for the math actually play out in a way that kind of passes the smile test? And so that's the one challenge you would have had for Estee Lauder. And it also gets back to the consistency, because I know there should be a correlation between ROE and ROIC. If I'm improving the ROE in my PE analysis, right, and using a higher ROE, and I'm not doing it for my ROIC, well, then that's also it's showing a inconsistency between the two multiples, right? Because there
Gotcha.
should be a relation between the multiples.
So, not
So
to
if
add
you had
on,
done that in your ROEs, you should have had terrible ROE performance, much lower than what's in that EEO. In the long, that
right,
would
so-
have to use a low ROE to match the low ROIC going forward. You can't
Right.
have a low ROIC and a gigantically high ROE.
right. So, another question I have then, I guess, is, so when I was doing it and using like an ROIC of 6%, which, you know, now I know is obviously too low, but when doing that and doing the goal seek, I was able to get to a G that is positive despite it having a negative spread,
Okay, what G was it?
a G of 12.3%.
Okay, which leads to math problem number 2. Why is 12.3% an incorrect, invalid G?
Because it's so much higher than what it is on the PE.
No, because it's so much higher than your WACC. You're in perpetuity. Remember dealing perpetuities. Your G can never be higher than your WACC.
Hmm.
So that's the other problem, is that you essentially have an invalid perpetuity, because you're bounded by your WACC on your G. And so you had to put in something that mathematically is incorrect to solve for the actual multiple.
Gotcha. Okay.
Young?
I didn't realize that I still had my hands up. Most of my questions had been answered, but
Okay.
but basically, it was a similar question as the previous one. I ended up using the ROE and then using the the capital weight to figure out. But for the other two, I used the screen. So the growth rate for it came out to be for Estee Lauder a 6.13, but because I used 8.1 for Rickard, I only have 6.47, which is much higher than what I was seeing on PE. So I just wanted to, wanted to check with you whether that would be okay.
Well, like I said, it's not going to be 1-to-1, but the G's should be somewhat correlated, meaning you shouldn't have 6% on one and 3% on the other. Shouldn't be that dramatic a difference. Unless there's like some extreme leverage going on, where you're leveraged 9-to-1 debt to equity, because you have such little equity in your firm that it's gigantically revving up your ROE, but I don't think that's happening with these consumer products companies. Yeah, Dory?
For the back to that relationship between ROE and ROIC, assuming that the leverage stays constant, can we assume that, because what I did was I took the percentage increase in ROE from the PE and the like the actual and the one I had in the model.
Yep.
And then applying that percentage increase to the current ROIC.
So here's a way to think of this. In my undergrad section last semester, one of my TAs came out with this homework helper that he started giving to the undergrad students. And I'm giving this to you. It's now in that files folder for the week 5 solution. And what we were talking about, just to kind of help them kind of visualize this, they said, okay, to show the correlation between operating ROIC and ROE, you know, approximately what we talked about last week is you take the debt to equity ratio, and from ROIC, you can approximate an ROE. Now, it's not 1-to-1 because this profit in the ROIC is NOPAT, and this profit in the ROE is net income. So we're kind of, as I said, it's a loose correlation rather than a mathematical certainty, but they're still generally related by the leverage ratio. So what he said is if you took the ROIC, you put in the leverage, which you can get right out the whack screen. Okay, so right here on Estee Lauder as an example, Estee Lauder is right now about 85% equity and 15% WACC. Okay, or sorry, 50% debt in their WACC. So if you kind of put in 85% equity, 50% debt, then 30% ROIC becomes about a 35% ROE. So what I did for the solution, my solution, is I worked backwards. Said, okay, what gets me to about a 35% ROE, which is consistent? Well, that's going to be somewhere around, back again, I just kind of plugged in a couple numbers without you goal seek, about a 30% ROIC. Okay, and that's actually how I got to the long-term ROIC number. Now, again, you could say, well, 27, 30, 33 in that range. But the whole point is, if you're going to use a much better ROE for them in the PE, you're assuming their performance is improving. All right. And the only way you're going to get to that improved performance is the operating performance improves, which is the operating ROIC can't be a negative spread. And so these are just some of the things that take a little experience, but it's just kind of really starting to understand the relationships here we're talking about in these formulas, because it gets back to the perpetuity. Yeah. Yes.
Yep. I did that a little bit differently. I use the FY 2025, the FY 2-year data.
Okay.
I use ROE and the net income to calculate the equity, and then use the data and equity to calculate the ROIC for the
And what
year.
did you get for the ROIC?
Yeah.
What did you get?
I use the FY 2-year data.
Yeah.
The ROIC 14.22.
Okay. Well, the point is, you're basically suggesting that the performance isn't going to be as good as what I'm suggesting here, but it is improved and it is a positive spread. And I bet you're getting a G that is probably a little higher, but it's still lower than the cost of capital.
Yeah,
And so
6.8 or something. Yeah.
Yeah, and I'm just saying that there's a scenario where that could be explained. Right? I'm not saying I would explain it slightly differently, but I can't say that that's not an explainable scenario. But that was why I tried to give you that hint on the homework. And then what I ended up doing for Reckitt is I said, well, if I'm going to do this for Estee Lauder, I'm just going to kind of sync it up for all three. All right. So you didn't have to do it this way, but I kind of did that in my solution. Right. Because I assumed that same thing was happening at Reckitt, is that they were improving their performance. And if I was giving them an improvement in performance for the ROE, then I also wanted to sync up the improvement in the ROIC. So again, they had a slightly different debt to equity ratio, but essentially somewhat correlated improvement in ROIC, improvement in ROE. And so I just did it for all three. So again, if you had used something like you just said for Reckitt, 14% ROIC, I'm not going to say that that's wrong. The only one that clearly you can't really have for my grading purposes, you can't have a negative spread for Estee Lauder. You would have had to improve the ROIC. That's why I gave that hint in the announcements a couple of days ago. Is this gone over the heads of anybody? Are we all following and tracking? And by the way, if anybody's paying attention to the headlines, so the Reckitt guy who's improving this performance got hired by who? 18 months ago. Who hired the guy that was involved in improving Reckitt's performance to become their CEO? And by the way, he was unceremoniously fired today.
You talking about the Starbucks guy?
Yeah. Starbucks CEO, who was fired today, to be replaced by the Chipotle CEO, was actually running Reckitt. And that's why they hired him. They hired the Starbucks, hired the Reckitt guy because of these improving numbers that you see. He came in, Starbucks is falling off a cliff, and then they just fired his ass today and replaced it with Chipotle. So he didn't last very long. Because basically, Reckitt sells like Lysol. And I'm not saying that, you know, coffee and Lysol are the same, but they're clearly not. He did not understand the Starbucks business that he was trying to run. Anyhow, little digression there. Patrick?
Yeah, so for our group project on the multiples analysis, obviously we'll all have different peer companies. Would you recommend we use this template here as an estimation approximation? Because we'll have.
Yeah, exactly.
Yeah, okay.
After we've had this conversation and with this template, it might help make it a little bit more consistent.
Okay.
In an
Thank
approach.
you.
Absolutely. And so that's why I put it in the week 5 folder. Yes. Other thoughts, questions? All right, so back to my solution. That's up there. So here's the thing. The key here is this one. This one you had to have had a higher ROIC. Not saying it had to be 30%, but it can't be a negative spread for reasons we talked about earlier. That's going to be important in terms of the grading. Had to be a positive spread. For Reckitt, you didn't have to have as high ROIC as I had. All right, if you'd use the historical ROIC for Reckitt, I will accept that for purposes of grading this assignment. Okay, because the historical method was something last week we talked about as potential. I think it should have improved, but if you didn't improve it, I'll still give you credit for that, so long as you explain why you did what you did in the write-up. But so if you did, by the way, you're going to have slightly different numbers because you're going to have a higher G and a lower ROIC, right? And the same is going to be true for Estee Lauder. Like if you improved Estee Lauder, but not to 30%, then your G is probably giving me the 6% range and the ROIC is going to be lower, but that would have been necessary. And same thing to some degree for P&G. So it could be slightly different numbers, but directionally, the most important one is Estee Lauder. You couldn't have used last year's numbers. All right, then you had to explain premium or discount. So first one, P&G versus Estee Lauder, their multiples are pretty similar. 22.6 and 23.19 are not that much different. But nonetheless, why is Estee Lauder trading a slight premium? They're kind of getting there in different ways. The reason it's trading premium is that P&G actually has a slightly better spread. 34 minus 8 is about 16 points of spread. 33 minus 10 is about 13 points of spread. Slightly higher spread at P&G, but Estee Lauder has a much higher growth rate of 6.08% a year versus 4.2% a year. So it's the much higher growth rate of about 2% a year compounded that's giving them a higher multiple. But what's offsetting that is the cost of equity, because you're discounting that at 9.6% versus 8.1 at P&G. So that's kind of offsetting why the multiple is not higher, but the premium is really because of the growth. And as I'm saying, if they had the same cost of equity, you do a little math, their multiple will be 40, almost double the stock price, right? So that higher cost of equity is having a big drag on Estee Lauder's performance, but nonetheless, the higher growth is why they're having the higher multiple. In terms of why is Reckitt trading at a discount to both, and particularly P&G, their spread's not terrible. It's the lower spread of the three companies, about 18 points. But what they lack is growth. They're only expected to grow in this scenario about 1% a year versus P&G's 4% a year. And that's a big difference when you're talking about compounding. And that's why they're trading at a discount of about 12 versus a PE of about 22.6. So this one should have been very explainable and relatively straightforward. We get over to EV to EBIT. The one thing that we see is that P&G now has a slightly higher EV to EBIT than Estee Lauder, effect of the non-operating items and the debt. But regardless, why is P&G trading at a premium to Estee Lauder and the EV to EBIT? Well, first of all, again, very similar spreads in the way that I played it out. 31% ROIC and 30% ROIC against about an 8%, 9% WACC. So very similar spreads. The G at Estee Lauder is again expected to be higher, 5.8% versus around 4%. And the one thing that's hurting Estee Lauder, why the multiples are not higher, is they're paying a much higher tax rate if I leave it at 35%. And same thing, they have a much higher cost of capital, 8.7 versus 7.7. So that's actually why they're trading at a discount despite that high growth rate. It's the taxes and the WACC. In terms of Reckitt, why are they trading at a discount? Same as the previous slide. It's the essentially relative to P&G, they got similar risks, 7.7 and 7.9 WACCs, but they lack the growth. Again, 1% growth here, 4% growth for P&G, and 6% for Estee Lauder. So again, taxes in the middle, 25.5%. It's hurting them against P&G. It's 20, 21, but it's really the lack of growth. So it's pretty consistent between the two analyses that Reckitt's lack of growth, despite the high spreads, is why their multiples low compared to the other two. In terms of EV to sales, why are you paying more P&G EV to sales than Estee Lauder? Is the margin. 25% margin versus 13% margin. Generally, the bias is that I'll pay more for revenue when you have a high margin. Now, P&G is spending more, productivity 0.64 versus 0.29 to generate those margins. But nonetheless, it's the much higher margin that's a higher EV to sales. What's interesting is why Reckitt EV to sales are so low, 2.5 versus 4.7 at P&G. Their margins are pretty high, 24% pre-tax and about 18% after tax. Their productivity is worse, 0.84 versus 0.64, not dramatically. The problem with Reckitt is the lack of growth. Because remember, it's the growth margin combination eventually, just goes in the EV multiple. It's part of the EV to sales multiple. But the point here is that what the market is basically saying about Reckitt is despite the high margins, they're not growing their sales all that much. So the sales growth is not going to lead to a lot of value relative to P&G, because P&G is going to grow those high sales at a much faster rate. And that's why it's the 4.67 versus the 2.48. That one was a little bit more nuanced, but nonetheless, it's still explainable with the key value drivers. Questions, comments, concerns, crippling fears about any of this? All right, you have the solution. This is being recorded. Have all the grades in, by the way, probably by Thursday or Friday this week, including this one. So that should be to get you ready for your group projects next week. But before we talk about the group projects, I do want to briefly talk about the midterms. Part one, I'll just put up the math solution for that, for the conversion, and you can check that against the solution. In terms of part two, basically, you had to explain the premiums or discounts similar to what we just did for A, B, and C. Okay. And the key here is that between A and B, why is A trading at a discount to B? Well, the primary reason is the lower growth of 3.5% versus the 4.5% for similar spreads. That's the gist of what you had to say. Why is C trading at a discount to A? It's the lack of growth, 1.95 versus the 3.49, even though they have a slightly higher spread. And also the slightly higher WACC of 9 versus 8.4. In a way, A, B, and C are very similar to the homework assignment I gave you in week 6, in terms of the way things played out. Okay, C is like Reckitt with a small growth, A is like P&G with a mid growth, and B was like Estee Lauder with a high G. But regardless, these were made up numbers, but that's what you had to say approximately for this question. For question 2, using the key value drivers, explain the trade-off between increasing reinvestment rate or the payout rate. Remember that these two ratios, reinvestment rate and payout rate, have to add up to 100%. So 1 minus the reinvestment rate is the payout rate, 1 minus the payout rate is the reinvestment rate. And so when do you want to increase reinvestment and decrease payout? Basically, it's all about spread. When you can incrementally earn a positive spread, you want to reinvest. When you can't earn a positive spread, you want to pay out, right? And that's going to be the key, is that if you can earn more than your cost of capital, why would you want to pay out? Investors, from an opportunity cost standpoint, if you pay them out, they're going to go try and earn their cost of capital someplace else. Well, if I can beat that here, I don't need to beat that here. I want you to reinvest. So that's the whole point. This is really just a question about spread. And so when you have a positive spread, you want to reinvest. When you have a negative spread, you want to pay out. And it's the incremental dollar. Key value drivers would have shown you that if you played around with the equation as well. Number 3, what's the impact of a share repurchase? Funded by a reduction of excess cash. The key here is it doesn't affect free cash flow, right? Which means it's not going to affect the operating value of the firm. So it's just a distribution of cash, right? And so you're changing the debt and equity, but you're not affecting the operating value of the firm. And that's the whole point here, right? Because free cash flow has nothing to do with whether you're buying back stock or issuing stock, right? It's below the line in the CFI, right? And so yes, it'll affect the non-operating value, but it will not affect the operating value of the firm. Question 4 is just walking through the ROIC tree. And again, this gets back to the 2 levels. So talk about the tax rate, margin, productivity first. Okay, so why did the ROIC improve from 19 to 26? Well, tax rate was one of the drivers because tax rate went from 35 to 24. So that was helpful to the ROIC. And the pre-tax also improved from 29 to 34 because the operating margin went from 29 to 42. So that was a big driver, the pre-tax ROIC going up. And that offset the worsening of the invested capital sales ratio, which went from 99 cents to $1.23. That would have hurt the ROIC. So the pre-tax all was because of the improvement in the operating margin, and the operating margin cash tax rate improvement showed the after-tax ROIC going from 19 to 25.9. Second level drivers, why the operating margin improve? Number 1, gross margin went from 44 to 58. So that was the primary reason the operating margin improved. SG&A stayed pretty flat, 9.1 to 9.3, and depreciation actually went up unfavorably by a penny. So all the operating margin was gross margin. Invested capital sales, why did it get worse? Well, they went from essentially no working capital to 3 cents. So that's 3 cents to the unfavorable. They went from 89.5 cents to $1.09 of PP&E. That was very unfavorable. And intangibles went from 10 to 11, 1 cent unfavorable. So all 3 of these got more unfavorable, but the real driver was the PP&E. That led to the high increase in invested capital to sales. So we talk about first and second level drivers. That's what we mean. First level drivers, second level drivers. Got to talk about both in your analysis. And then the final question. was the CFI. So again, the CFI, 4 sections. Free cash flow of 30 billion. If you just focus on the total, 35 billion of gross cash flow, 29.7 billion of gross investment. Basically, they spent on average the reinvestment rate. That looks like an error. 29 divided by 35 is not 16%. So hopefully you guys caught that error. It's not a 16% reinvestment rate. And essentially, whatever that reinvestment rate was, they didn't really do a lot of acquisitions, negative 500 million of goodwill. And if I look at the CapEx depreciation ratio, CapEx about $1.9 billion, depreciation $1.5 billion. This company was not expecting to grow very dramatically in the next year. What'd they do with their 30 billion of free cash flow? Well, they turned that into 33 billion of CFI because they had 3 billion of non-operating cash flow. Basically, they decreased their excess cash by about 1.8 billion, and they sold off about $1 billion in non-operating assets. That got them to 33 billion to pay out. They also borrowed $17 billion worth of debt. That's essentially 50 because they paid out 46 billion in dividends and share repurchase. 16 billion in dividends, 30 billion in share repurchase, and another 3 billion of interest. That's where the 40 billion went. So something along those lines is what you have needed to say for the CFI. And then your final question, did you follow the honor code? Hopefully everybody said yes. That was an easy one. Questions about that? All right, group projects. So next week, is the final week of class. All of you have chosen your companies, and the entire session next week is basically the presentations. You will have 20 minutes each to present on your company, and we'll talk through what's in it. But essentially, what you're going to present through in the live sessions is listed here in the assignments. Valuation project. The 4 sections of the class for the company that you have chosen, right? And I'm going to give you a choice, right? So the original goal of the project was to have you do a paper and a PowerPoint presentation of the same material, okay? Now, I'm going to give you the option to have all 40% of your grade just be the PowerPoint. I'll let you choose. So you could do a paper, which is worth, got to do all 4 sections of both. All right, one just written, the other's verbal. They're going to add up to 40%. But option 1 is, as in the syllabus, paper's worth 16 points, 4 points a section. PowerPoint worth 24 points, 6 points a section. Or you could just do 40 points in your PowerPoint next week and not have to write a paper. So if you want to commiserate amongst yourselves and let me know the option, I will give you that option. You just have to let me know. So, Meta, would you prefer to do both, or would you rather just roll the dice on your PowerPoint presentation?
Yeah, Professor promoting that. Should we vote to decide the same for all groups?
I'm going to ask Chipotle and AstraZeneca the same question.
I'm good with just the PowerPoint presentation, but I don't want to speak for our whole group.
Well, you kind of, but you got to all talk. So Meta, start with the Meta people. What do you think, Meta? You
Just the
wanna write paper?
PowerPoint sounds pretty good.
Yeah,
Yeah, PowerPoint is fine.
let's roll the dice.
Okay. By the way, it's better for me. It's less for me to read. So I like that option, but I'm just
Let's do Professor a favor and So still with the
Let's raise, yeah.
Yeah, help me help you. Barry McGuire. All right, so Meta's gonna go with the paper. All right, what about Chipotle?
No, I think we said we're gonna go with the PowerPoint.
Yeah,
Yeah, just the PowerPoint.
PowerPoint, sorry, they're going to all, no, yeah, it's not, it's all PowerPoint. So Chipotle,
PowerPoint.
all PowerPoint. AstraZeneca,
So, I mean, we can go with PowerPoint if everybody wants to, but we have done the paper also, Professor. It doesn't matter.
I'm asking, I'm not forcing you to do either choice. That's why it's called choice.
I don't know. I don't know. Michelle, what do you guys think?
Oh man.
Well, they're thinking Domino's. Does Domino's have an opinion?
Domino's will go with the PowerPoint.
We all agreed on the Domino's team for that?
Yeah, we're messaging in our,
Okay.
our group messaging.
All right, so AstraZeneca, have you decided?
I guess we can just do the PowerPoint. I mean, it seems like that's what's going on here.
Yeah.
Not peer pressure, it's a choice.
Since you have done the paper, we'll put the paper also. But yeah, PowerPoint is fine, I guess. It's okay.
Okay. All right, so then what I'll edit this here, but what this means is that the PowerPoint's worth 40 points. And each of the sections is worth 10 points. Okay, just be really clear. All right, that's what you're choosing. If you change your mind, let me know. All right. But that's what I'm going to change and adjust the assignment to represent that. All right. So back to this. What does that mean? So where is assignments? So what you're going to do in your PowerPoint is 20 minutes, 4 sections, approximately 5 minutes per section. Now, because we only have an hour and a half next week and we gotta get through 4 teams, I'm gonna hold you to the 20 minutes. So basically, I'm gonna have a little timer going on, and when 20 minutes is up, you're done. Okay, and if you don't get to everything in that 20 minutes, I'm not gonna give you credit for it. So you have to get through all 4 sections in the 20 minutes. So practice. That's what I'd strongly recommend before showing up next week. All right, so what is gonna be in that PowerPoint? Right? So first thing is you have cover page with your buy, sell, hold recommendation coming right off of your valuation models, right? So Meta, target share price of X, this is my buy, sell, hold. Then each of you will get into the EIC, okay? So make sure all of your screenshots are in that PowerPoint. Okay, you can't leave the PowerPoint to show me other data. So you should have an RV beta screenshot, and you should have a spread screenshot that you're referring to as you go through the EIC. And just like your assignment, you got to talk about the economic sensitivity, referring to your beta. You got to do a 5 forces today, 5 forces 5 years. And you got to talk about the competitive advantage and where that's going to change in 5 years. Don't forget to use numbers. Okay, so that's the first section. Second section, you're going to do an ROIC tree of your company, and you're going to do a CFI analysis of your company. Okay, you're going to get that right out of your as-is valuation model. Put those trees and the CFI right into your PowerPoint, and you got to go through it. Section 3, multiple analysis. You're going to do your company against 2 peers. And in just a minute, I'm going to ask who those peers are, and then we'll actually get the data for those peers. And then so basically you will do that analysis, very similar to your week 6 homework assignment that we just went over. That's about 5 minutes. And then the final 5 minutes is the valuation, as is bull, bear, target, talking through the assumptions as you went through each of the 3 models, just like you did in your homework assignment. Okay, so that's what the PowerPoint is going to entail. That's kind of your end of semester group project. Now, I will tell you, based on historical presentations, the EIC tends to go long, okay? Because you're trying to get through all the 5 forces, takes a while. And just be careful, because if you spend like 10 minutes on EIC, you're going to give short shrift to other parts of this project, and each one of these sections is worth 10 points, okay? So you don't want to run out of time and not get to your valuation models because you spend all your time on your EIC and all your time on your multiples. So just pace yourselves. And you're gonna have, like I said, approximately 5 minutes. So maybe you go 6, but I wouldn't go 10, because each section is equal weight, right? And if I'm scaring everybody into writing the paper again, there's no time limit on papers. You're still welcome to go back, but I'm just letting you know that it's 20 minutes per team to get through all of this. Patrick?
Yeah, do you have a strict grading criteria on which peers we choose? And I guess like just in general,
Well,
is
we're
your
gonna pick the peers.
recommendation?
We're gonna pick the peers tonight.
Yeah, but it like in general, is your recommendation to choose a peer that's on that beta or that spread screen from Bloomberg, or because I
Yeah,
guess we're the Domino's team, and we've been talking about some, you know, just our specific example in the JP Morgan article you gave us. You know, they compare Pizza Hut. Yeah, Pizza Hut and Papa John's, and Papa John's is an easy compare, you know, direct compare. But Pizza Hut's owned by Yum Brands, which is it's like a conglomerate, so it gets a little iffy there. So, you know, do you recommend us do additional research and try to figure this out real quick, or is it best to just stick to that screenshot and that JP Morgan analysis?
No, well, there's two answers to this. One is, this is the real world where it's not as easy to find the peers for reasons you just said, and we have to make some compromises. But I'll also say, in the context of this class, I will let you choose peers that are easier to explain. So try
Okay.
not, if it's very difficult, and if it's not exactly 1-to-1, meaning Domino's is, think of it as a fast casual. So as long
Okay.
as another fast casual peer off the list, that's perfectly fine.
Okay, that helps. Thank you.
For this assignment. But I think you did bring up a real issue, which, probably JP Morgan was even struggling with. They tried to pull out Pizza Hut if they're part of PepsiCo. John?
Yeah, just wanted to know if you have a range of time, like 18 minutes to 20 minutes would be okay, or are you looking for exactly, almost 19 point,
I mean, this is not the Olympics, and but the point is, you got to cover the 4 sections. So if you can get through all the 4 sections in less than 20 minutes and cover all the data, that's perfectly fine. I just want to make sure that you get all through that within 20 minutes. That's the most important thing, and that's why I really strongly suggest practice. Like, don't make next week in class the very first time that this is being presented. And by the way, where it breaks down is when you assign as a team different people, different sections. Okay. And then what they do is they all present their sections, but at the same time, they don't practice together. And that's when you start to realize that time becomes an issue. So practice all the sections, particularly if different people are doing the different sections. By the way, the other thing that tends to hurt the historical grading, which you might see me laughing, is that when you contradict each other across your sections, right? So somebody in the EIC is like, this is the worst industry ever, and then somebody in the bull bear is talking about the greatness of everything, and the target is like 30% higher. And it's like, did you listen to yourselves 5 minutes ago? So again, there should be consistency across what you're talking about in the data. Same thing, you shouldn't have a dramatically different ROIC in your multiple analysis than in your DCF valuations, right? Because again, same company, it shouldn't have dramatically different results. So just be consistent across your sections. Stephen?
Yeah, just going back to Patrick's question, for more clarity. We were thinking for Meta, we wanted to compare against other large tech companies, but they are not included in the spread page.
Well, let's get to that right now. So here is Meta. Start with you guys, because I'm going to go grab the data. So let's talk about who I'm grabbing the data for. And oh, by the way, what I'm going to do is, in this file folder, I'm going to put all the new data in your teams folder. It's team data. And I believe I'm still sharing my screen so you can see this. So for Meta as an example, I'm going to put a folder in here called update. Okay. And in this, each of you will have a folder right now, just for illustrative purposes, called update. And I'm going to put the updated data in the update folder. Now, to also be consistent, I'm gonna take the EEO screenshot and the WAC screenshot and the DES screenshot today. Okay, so even though it's there, like if you've already started doing your valuation, re-put in the assumptions from today. Just because if you're gonna be doing the comparisons, I want them compared at the same time. And also the DCF needs to be in sync with your multiple analysis. So we can't have a DCF from 2 weeks ago and a multiple analysis from today because the multiples won't sync up with that valuation. So I'm gonna redo the screenshots, put them all in that update form folder for your company. Plus, I will put in the other 2 companies that you choose, just for everybody's benefit. Okay, so let's go back to Meta. So here is the pure list. I'm gonna put the bigger companies on top. So, how about if I give you this list? Internet and media companies.
You want us to choose based off this list as opposed to like an
Oh.
Apple, Microsoft, Google,
You tell me who you want to use as your peers for Meta.
Google and Microsoft.
Okay, I'll let you do that.
Cool.
So what I'll do is I'll have to add them to the RV screen and redo it because they're not part of your original RV screen. So I'll give you the adjusted RV screen for that. So let me just go ahead and keep track of this. So Meta. And you said Google and Microsoft, or Alphabet and Microsoft?
Yeah.
Okay. All right, in no particular order, AstraZeneca. Do you know who you want, or do you want me to show you the screen so we can pick?
Yeah, can you pull it up?
Spreads back on here if you want to see that. This will basically be the screenshot that you have.
Yeah, I was thinking Pfizer and Bristol Myers.
Okay. That should be fine. Although Bristol Myers had a really bad year last year.
Ooh.
Which means they're gonna have a multiple challenge because that's probably not the expectation of the future.
Let's change it to Merck for the other one.
Okay. So Merck and Pfizer,
Yeah.
right? Who the other 2 were. So Chipotle. You guys get to talk about the CEO who just quit and went to Starbucks.
Can you pull up the thank you.
I have a bias.
I hope it's a positive bias.
No, I'm just saying that if the CEO just quit and went to Starbucks, and Starbucks is obviously, somebody that they felt Chipotle could, benefit them, maybe be interesting to do Starbucks. But I'll let you choose. Again, I'll put the bigger companies up top.
What are the consequences if a CEO just quits and moves to a different company like that?
It's a good question. You can see the share price pretty unchanged today, but it really probably depends on who they select as their next leader, because right now, the guy who's running Chipotle is viewed as a rock star in the industry, because I don't know if you guys remember, Chipotle really struggled with that E. coli problem a number of years ago, and it really hurt their brand. And they brought in this guy, and he kind of turned it around. And Chipotle is almost like completely left that behind them, and they're now growing again. Their margins have been improving. Their same store sales are improving. You know, the stores are full again. And so I think that's what's attracted Starbucks. The Starbucks right now is the opposite problem. They raised price dramatically for their coffee. Same store sales are down. Revenue is expected to be down. Margins are collapsing. It's like Nike. Nike's having another similar problem, with sales expected to shrink next year, which has been a complete shock to their historical system of growth. So
Does that have anything to do with the unionization of Starbucks employees?
well, I think they've fended most of that off in mass. But you know, what I'll say is, politics aside, if the company's doing well and the workers, you know, are incentivized with options and stuff, no one's asking about unions. It's usually when the companies are like cutting and struggling and not doing well, that's when the unions tend to show up. But and so that's what, you know, Starbucks, they've been cutting and more struggling, and the baristas have been asked to do more with less. And actually, one of their biggest challenges is the online ordering, because what I was reading about, it kind of makes sense, is the online ordering has added so much friggin' complexity, because in the app you can customize to your heart's content whatever weird coffee combination you want. You know, the double soy mocha latte, whatever, with 2 squirts of these things, and it's really slowed down their whole process. And so the lines are getting longer because it takes a lot more time to make an order. And so I think that's one of the challenges that Starbucks is having, is all that customization that they're allowing. It's killing them, and it's hurting the supply chain as well, driving up cost. But that's not for this conversation. So who do you want, Chipotle?
I think we'll do McDonald's as one.
Okay.
Is it an issue? I'm looking at Shake Shack and they have quite the negative spread. Is that an issue for analysis purposes?
It's going to be an issue because to get to the multiples, which are going to be pretty high, you're going to have to make some adjustments about that future returns. So it's not an issue. I'm just saying it's going to be like a little bit like the Estee Lauder example you just did. So I will commend you for doing it, but if you screw it up, I'll still grade you down.
Let's do Starbucks. Why not?
You can do Yum.
Oh, okay. Well,
you don't have to.
Now let's go with Starbucks over Yum.
Okay.
Do we need 2 or 3 competitors?
2. Yours plus 2. So you are going to be Chipotle. Let's put the ticker in here. McDonald's and S-Bucks. All right.
Can I, real quick before we go on, can I just tell Young I appreciate you asking that question, giving us time to deliberate in our chat. That was very valuable for our team.
Okay, great. All right. And then finally, Domino's. Did you guys resolve?
Yeah, I think we're gonna do Papa John's and Chipotle.
Okay. So Pampa and Chipotle. Where's that? All right. So all right. Let's just check one thing real quick. So for Chipotle, just looking to see if there's any issues with these multiples. Let's see any. Okay. And my Starbucks team. No. Okay. All right. So these are the companies. What I'm gonna do is, yeah, go ahead.
Yep, here a quick question here. For Meta, we are trying to compare with Google and Microsoft. They are all high-tech company.
Mhm.
But in the spread you provided for the screenshots for spreads, all those for kind of social media and all those companies, that sector is much, much smaller than Meta.
Well, what I'm gonna do is I'm gonna take your screenshot and I'm gonna add those two companies and redo it.
All right, great. Because I don't want to, when we do EIC analysis, is talk about two different industry sections.
Yeah. But I guess the point is, when you're doing your EIC, the one challenge that you're gonna have, if I think forward to this, is that Meta and is more social media. Google is ads, they're an ad company.
Yeah.
And Microsoft, LinkedIn, little social media, a little ad, but they also have their cloud business and some other stuff. So when you define the industry, I think the five forces is going to be a little bit of a challenge.
Yeah.
I think they're gonna likely probably converge, with the AI and compete for your screen time. So maybe
Well, again,
perhaps.
I'm just giving you, I'm looking ahead, but you're going to have to kind of resolve all of that when you talk about your EIC.
I will try.
That makes sense. So do we want to lock in? Meta, are you good?
It's hard to find a similar social media company with similar size of
Well, you're
Meta.
not going to find similar size. I'm just saying, you're not going to find similar size. Snap, although their performance is very poor. Now, what we could do is I can make this a global list, which adds like Alibaba. And that, let's see else on the global list.
You mean WeChat?
Is WeChat public?
Yeah, I think WeChat is public. Tencent, Tencent.
Yeah, so Tencent and Baba might be better peers for Meta. Especially if you look at internet media.
Is Alibaba a social company? Not sure. They're like eBay.
I thought it was like an all-in-one, social purchasing.
I mean, Tencent is all in one. Alibaba is different.
Let's just see who's big here. Global internet. Where is? Why is that not showing up? Let me look up Baba and see if Facebook is on their peer list or Meta's on their peer list.
Is MySpace still around?
Is MySpace still around? I don't even know.
Yeah,
Yeah,
they're
'cause
listed with the
Alibaba is more. Let's see, where's Tencent listed? Hong Kong.
Yep.
Just seeing if Meta is listed as one of their peers, and then.
Yep, Meta is here.
All right, so Tencent, Alphabet, Meta. I can
Yep.
give you the list.
Yeah, this will make more sense.
Okay. All right, so let me give you, I'm gonna actually take this screenshot right now. This will be the screenshot that I'm gonna revise for your updated data. Okay,
Yep, thank you.
no problem. Hopefully everybody else actually saw something interesting as we were doing this, because it gets back to finding peers. And as I said, this is not always an easy exercise when you really try and do the analysis. So that was an illustration there. All right, Greg?
Yeah, sorry. One question you might have already addressed and might have just gotten scrambled with everything else we were talking about finding the peers.
Mhm.
For the presentation, do you need everybody in the group to present or? Okay.
No, I don't need everybody to present, but I need everybody to participate. And if you feel, because you're gonna get a group grade for this, right? And I didn't put in the syllabus formal peer reviews, but if your team members come to me and say, you know, you didn't participate, then I'm not gonna give you the 40%. I'll give you 0. So that's the point. Like, you don't have to all present, but you gotta at least help create the presentation, because you can't get credit for something you didn't do. So hopefully that's not an issue. I don't think it's gonna be an issue, but I'll let you decide who you want to present on behalf of the team. But the other side is if they present, they screw it up, well, it's the group grade. So if you need to use note cards or anything like that, that's perfectly fine. You can even script what you're gonna say. But if it's not in the PowerPoint, it doesn't count. So make sure you put all the data in the PowerPoint. Same thing. When you get to your as-is bull bear target, take screenshots. I've seen effective in the past. Take screenshots of your ratios and your assumptions, and then a few bullets. Here's what I changed and why. Okay, as you go through the 3 models, or the 4 models actually. Probably easiest way to do that. You know, make sure you have your screenshot of 3 peers: EV to EBIT, PE multiples, EV to sales. Those 2 Excel screenshots in there when you're trying to explain it. You know, ROIC tree, CFI got to be in there. You know, screenshots for the beta and the the industry spread need to be in there, that you're referring to numbers as you go through the presentations. 20 minutes, 4 teams, hour and a half to finish. Final week of class. If you have any questions beyond this, please reach out. If you need any more data, please reach out. But as I said, as soon as this class is over later tonight, I'll be putting in all the data. So by tomorrow morning, it should be in that update folder for each of your teams, including your own data being updated as well. Any final questions before we let everybody go? All right, well, I'm looking forward to next week. Looking forward to learning a lot about these companies and industries. So best of luck, and I'll see everybody in a week. Have a good day.
Thank you, Professor.
Thank you.
Thank you, Professor.
Thank you.